Hi, greetings for the day. I hope you're all doing well and staying safe. Today we will discuss about a topic from chapter number 3, Information System and its components. And the topic is Tools for IS Audit. IS means Information Systems Audit. There are 5 tools that has been given in your syllabus, but in reality, please understand that these are all not the only tools available in the market. There are many tools available for doing the systems audit. But before we get into the each individual tool, let us have a quick understanding why we are depending on these new tools or what is the need for these tools. Nowadays, the organizations are becoming totally digitized. That means the entire transaction recording, processing, and reporting, everything happens on the systems, right? And also, the volume of transactions have increased a lot. If you take an example of any major e-commerce platform like Flipkart or Amazon, in a day, they'll process a million number of transactions. So this is the volume we are speaking about. And just visualize it, if somebody need to audit these IT systems, so it's practically impossible to review the transactions on one by one, right, due to the volume. And also the speed at which this transaction happens is also one of the major factor to depend on these system tools. Actually, we call these tools as CATs, computer assisted audit techniques. So using these tools, you can audit the systems. Okay. Now, the first technique we need to discuss as part of our syllabus is snapshot. Snapshot is a very generic word we use, right? Let's say on your mobiles, if you are taking any screenshot, or even on the laptop also, you take sometimes the screenshots whenever you feel that is important and you want to refer it at a later point of time. So that is a similar context in which the software also works. Let us see more details on this snapshot tool. I'll first read through the definition, and and at the same time we will also discuss in detail by using a practical example. If you still have any doubt, then we can come back to the definition and refer it further. So the definition says snapshot software is built into the system. Okay, first thing you need to keep in mind, this is a software. Okay, we are talking about a software. What they are going to do, they build into the system. Okay, which system? Whichever system you want to audit. In our case is basically client's system, client's application system where the transaction processing happens. Okay, so what they are doing, they are installing the software on client's system at those points where material processing occurs. Okay, just hold for a while to understand what does this material processing means, but let us see what it does next. So which takes the images of the flow of any transaction as it moves through the application. Okay, so this is the functionality of snapshot tool. What it does, they install this snapshot software in client machine to take the images of the transaction. But will it take the entire process? No, it takes where the material processing occurs. Now we can have a question, how the tool or a software knows in a particular transaction which is material to an organization. This has to be given, this input has to be given by the auditors. Okay, now what the auditors does with these images, so these images can be utilized to assess the authenticity, accuracy and completeness of processing carried out on the transaction. Okay, so by reviewing these images, they will evaluate whether the transaction have been processed accurately or with full authenticity. Okay, now the third point. So in this technique or a tool, what are all the main points we need to keep in mind? You need to identify the snapshot points based on materiality of the transaction. I told you, right? The software is not going to monitor the entire transaction. It is going to monitor only the areas which are critical to the organization. So You need to identify those critical points to give instruction to the snapshot software, and when the snapshot should be captured, and also once it captured, how this information should be presented. So these points you need to keep in mind when you are using this snapshot tool. Okay, so this is about the theory part. Let us take a practical example and understand how this snapshot tool can be leveraged. For our example sake, I have taken a procure to pay flow. I think you in chapter number 1, automated business process, you would have already gone through the P2P flow. Okay, this is how it looks like. So it starts with requisition document, and then it get approved, and then it will be converted into a purchase order against a supplier, which will also go for an approval. Once the purchase order is approved, it will be sent to the supplier. Once the supplier receives the purchase order, he sends the material based on the delivery terms, and along with that, he will also send an invoice. So invoice will be internally reviewed and approved, and finally make payment as per the payment terms. So this is a simple flow of P2P. Okay. So in this process, let us take the current organization have few control points. Okay. So control point 1, what they're saying, this which is given in yellow color, approved supplier list, means the purchase orders have to be created against a supplier which is already approved by the organization. That means if you want to buy an item, you can't directly go on a roadside shop and buy it. Okay, for certain items, so the organization has a policy, you have to buy from a specific supplier. So there are various reasons why they will have this approved supplier list. Now there is one more checkpoint in the transaction, which is three-way match. That means if an invoice need to be approved or even eligible for make a payment, it has to be a three-way match. What is meant by a three-way match? I'll give a straight away example. Let's say the PO quantity is 100. Okay, so what you have received is only 70. Maybe supplier is going to send the 30 at some other point of time, or maybe ourselves asked the shipment to be delivered in two stages. In first stage you sent only 70 quantity, and in the second stage you send the remaining 30 quantity. So in this case, when you are booking an invoice, okay, you are supposed to book an invoice for the quantity of 70 or less than 70. Okay, you cannot book an invoice for greater than 70. So this is basically one of a control many companies follows, because in this way it controls you cannot make payment more than what you received. In simple terms, see, I would have ordered 100, why I will pay for let's say 80 or 100 when I have not yet received. Okay, so that is the reason this is one of the control many organization follows. Okay, in this process we identified two critical areas where we need a snapshot. Okay, so the snapshot software has been given instruction to take images at these stages. Okay, whenever a transaction process goes with this entire life cycle, I don't want the images at let's say at requisition creation stage or requisition approval stage. All I want images at whether the PO has been created with the approved supplier or not is the point I want to review it. And at the same time, when the invoice is validated and sending for approval, I want to check whether it have been three-way matched or not. So we identified the snapshot points, and what this snapshot does, it takes the images of these transaction and keeps it in a separate file. So later the auditor reviews these images whenever they are reviewing the transactions, and they see, okay, this transaction have been created with an approved supplier list, so good, no issues, and also it has a three-way match. Then this transaction is successfully processed. It means without any issues they have processed this transaction. So this is how the snapshot tool have been used by the auditors to audit the transactions. I hope now it is clear. uh, let's quickly go back one more time to the definition part. By remembering this example, if you find still there is any gap, we can further discuss. See, the snapshot software is built into the system at those points where material processing occurs. In our example, the material processing points, one is the approved supplier list, another one is the three-way match, which takes the images of the flow of transaction as it moves through the application. So this is the snapshot tool. I hope you understood now what is a snapshot tool. Let's quickly move on to the next tool. Integrated test facility. Again, even here, let's have a quick look at the definition and I will try to explain with a practical example. What does this tool does? ITF, it's a short name of integrated test facility. It involves creation of dummy entity in application system. Okay, here also you need to keep in mind they are creating a dummy entity. Okay, that dummy entity you can simply remember like dummy transactions. Okay, or dummy master files. Again, the master file means you would have already read master versus non-master data, right? Example of master data, let's take in this example supplier master. They have created a dummy supplier called D. So where they are creating, again in the application system of the client where the actual transaction processing happens. So there they are creating this dummy data, and the processing of audit test data against the entity as a means of verifying processing authenticity, accuracy and completeness. Okay, fine, don't worry. Once you understood the example, it will be easy for you to understand the definition and what they are doing next. Test data would be included with the normal production data used as input to the application system. And auditor has to decide what would be the method used to enter test data and what is the methodology used for removal of effect of ITF transactions. Okay, let's discuss on the example, then we can come back to this definition to understand in detail. Okay, let's take. So in this diagram, this is the client application system. Let's say you call it as an ERP for our example sake, okay, where the transaction processing happens. Okay, normally there will be a live data. Production data means the actual business data. So the data will be entered into the application and which will get processed, and finally that will get posted in the database. This is a normal process, nothing to do with the ITF part. Okay, till here it is not something new you are understanding. It is the regular way how the transactions are processed. Now, what about this ITF tool does? In the production application, they create a dummy master. Let's say, as we have already discussed, they have created a supplier called D. Okay, so there is also a regular supplier called X. Okay, we are booking a supplier invoice, actual supplier invoice for X, and this invoice will get processed and finally the entry will get posted in the database. Okay, this is the right hand side process flow, whereas on the left hand side they create an invoice, okay, for supplier D and post it in the actual client application production environment. Only the transaction will get posted and then finally the data gets stored in the database. Once the transaction get posted, they know what is the final result of the transaction from the database. So they take the result of this transaction, and as it is a test data, auditor already knows the expected result. Okay, I know that I am booking an invoice, what should be the debit and credit entry and how much should be the amount. So basically they already know the end result, and finally they compare from the application whether these two results are tallied or not. If they both are tallied, that means the system is working as expected without any issue. So this is the ITF tool. Okay. I hope now it makes sense to you what is the ITF means. Now again we will go back to the definition and try to understand it more detail level. Now, ITF involves creation of dummy entity in application system file. In our example, we have a dummy supplier called D. Okay, and processing of audit test data. So they are doing, they have their own test data that needs to be processed against supplier D. Okay, so why they are doing it? By means of verifying processing authenticity, accuracy and completeness. Okay, see, I know what is the output. Okay, what should be the output? When I am given input to the system, if the system also works as I expected, the output from the system also matches to my expected result. Okay, so this is what an ITF does. But the challenges in this ITF tool is, as you are directly creating the data in a production environment, you need to be very careful. Okay, because this data might impact the production data for sure, right? When an example, in the previous example, you have created a dummy invoice for supplier D. When you are taking your supplier total balances, even this transaction will be shown as an outstanding transaction. So you should you need to be very careful when you are doing auditing using ITF technique. So that is what they want to highlight here. What would be the method used to enter test data? Okay, so there are two ways to do it. One is which is not part of your syllabus. I'm just giving a more details to understand this concept further. Okay, let's say in our example we created a supplier, dummy supplier called D, so that whenever somebody sees this transaction in the system, so they can easily say, hey, this supplier is not a real supplier, it's a dummy supplier, so don't bother about these transactions. So creating a dummy master file and processing the transactions against that dummy supplier. That is one way of entering transactions. There, the another way was using X only in the example, but for every transaction, I will in the invoice numbering, I use let's say D001. That means dummy 001, D002. So by even this methodology also, we can tag the dummy transactions even though they are in production environment, and ensure that to ignore these transactions whenever you are reviewing the any reports or any data you are publishing. So please ignore this data. So this is how the auditor has to find the ways to enter the data. Now, the second thing he need to keep in mind, the methodology used for removal of effect of these transactions. For sure, he has to uh, ensure that the impact of these transactions should be removed. Why? See, as you already know, you created some transactions which is not a genuine transactions. So for sure, the impact has to be eliminated in the production environment. So there are three ways using which you can eliminate the impact. Again, this is also not part of your syllabus. So just to make you understand this point, I'm giving the little more details. One is methodology used for removal of effect of ITF transactions. The simplest thing was do the reversal. Whatever you created a dummy transaction, just reverse the transaction so that the impact will be nullified, but the transaction will still be available in your production environment. Then the second thing was create for a minimal value. Okay, let's say don't create an invoice for 1 lakh or a 2 lakh or a 10 million. Okay, just create for 00001. See, we are not here to test whether the system is processing the big numbers or small numbers, right? We are more concerned on the process, whether the process is working as expected or not, and whether it is accurate or not. Whether it is a small number or big number, it gives the same result. So create with a small value, even though you leave it the dummy transactions in the system, it will not have any impact on the actual balances. The third one, which is complex in nature, was customize your programs. Okay, all the programs in your application, customize it in such a way not to include these transactions, dummy transactions, in any of their processing. Example, if I'm running my aging report of suppliers, don't consider this supplier at all, or don't consider the invoices starting with D001 number, something like that. I'm just giving an example. So like this, you can customize your programs so that that will be excluded from your reporting or processing point of view. So in this way, the auditor should be very careful to eliminate the impact of ITF transactions. So actually this is the flip side of this ITF tool as well. Since you are processing your data in a production environment, you should be very careful. Max to max, if something happens to the test data, nobody worries. But if something happens to the production or the actual data, everybody concerned. So the auditor has to be very careful in ensuring that the test data in no way impacting the production data. Okay, so this is what the ITF tool. Now let's move on to the SCARF, System Control Audit Review. In this technique, it is almost similar to the snapshot technique, but it is, I can say, a little bit enhanced or advanced than snapshot technique. Okay, but the functionality is more or same, but you can say the major difference was instead of at a specific points where it takes the images, in scarf technique you take the entire transaction process flow and put it in a separate record. Okay, at later point of time, auditor has to review the entire transaction flow to see if there are any issues in the transaction. Okay, this is also one of the drawback of scarf. Anyway, let's get into the definition and then we will discuss in detail. The SCARF technique involves embedding audit software modules within a host application system. Here also the same commonality. Here they are embedding the audit software modules within a host application system. In the client machine, you are installing the audit module, okay, to provide continuous monitoring of system transactions. Okay, this is the major advantage of these computer assisted audit techniques. So we want these tools to continuously monitor the transactions. So whenever some fraudulent or erroneous transaction happens, auditors will have a look at and investigate further. And what this tool does, the information collected is written onto a special audit file called the SCARF master file. Okay, then what this data will be, how this data will be used. Auditors examine the information contained on this file to see if some aspect of the application system needs follow-up. Okay, so it's not that complex to understand. Basically, they install an audit module in the client application system. What it does, it continuously monitor the transactions. And but again, you can have a question. Okay, will it monitor each and every transaction? Of course, no. If it is monitoring each and every transaction and recording in a separate file, why do you need to audit it? Means why you need a separate tool for that matter? You can straight away review each and every transaction in the application, right? So there will be definitely there will give some criteria based on which the tool select the transactions and put it in a separate file for further review. The fourth point gives more explanation on this. This SCARF technique is like the snapshot technique along with some other data collection capabilities. Okay, so I highlighted a few of the points in the box. Actually, these are not form part of your syllabus, but just to make you understand what is the other data collection capabilities and also how this SCARF technique tool works, you'll be able to understand with this discussion. One is the application system errors. Okay, so after installing this audit module, you can instruct this audit module to collect the data if there are any errors in the programs. Like if the program is errored out, so those things can be logged into the master file. Then later audit can review this data to see why the program have been errored out. Is it a technical error or it is any human made error? So something like that they can use for further investigation. So this is what I'm saying, right? Not each and every transaction will be recorded onto the master file. Only certain set of data will be monitored and completely put it in the master file. And also policy and procedure variances. So every organization will have a set of policies and procedures. If there are any variances on the transaction happens, this using this technique, you can again record the data into a separate master file. And also system exceptions. Let's say in the previous example, I have given that P2P flow, approved supplier list and a three-way match, right? For in case of utility bill, let's say electricity bill, the company is okay to relax the three-way match condition because for electricity, basically you don't raise a purchase order to the electricity department to get these many number of units or watts of electricity, right? At the month end, based on the consumption, electricity department directly sends an invoice. It will not wait for your purchase order to send an invoice. So there should be an exception. Okay. So as per the company policy, for electricity bills, you need not follow three-way match. Okay. So this is an exception. Now, based on these exceptions, this using this tool, you can monitor. Okay, apart from the agreed exceptions, are there any other transactions which have the similar way of transaction? Means, let's say other than electricity bill, there is a normal inventory item, but it didn't follow the three-way match. So these kind of transactions, it picks and put it in the master file for review. Even you can get the statistical data sample also using this technique. And snapshots and extended records we already discussed. Data profiling means, let's say basically you take example of users. Okay, on any user, what is the profile? Okay, what is his username, from where he logs in, what is the access he has? So it has all these attributes with this tool. And whenever any suspicious activity which deviates from the regular allowed pattern, so it collects the data and sets in the again this scarf master file. Even this observation will be recorded in the scarf master file. And also it also helps in the performance measurement. Means it collects all the statistical data, right? So whether the application is performing as expected or not, how efficiency it is performing. So all these KPI related attributes also it can capture and put it in the master file. Don't worry on the these points, because I have taken this uh, to explain you more what a scarf technique can do. Okay, so this is what a scarf technique. So it is similar to the snapshot technique, but the only difference, major difference you say, in snapshot technique, it only captures the images of the transactions where the material processing occurs. Whereas in the scarf technique, it takes the entire process flow of the transaction, but it will not do this activity for each and every transaction, only for certain category of transactions as listed in the bottom box. Okay, this is what scarf technique. Next, move on to the another one, continuous and intermittent solution. Okay, it's in short form, it is called CIS. This is again, let's have a quick look at the definition part. This section, okay, how the CIS will be executed. We will discuss the example and then come back. The rest of the topics is very easy to understand. This is a variation of SCARF continuous audit technique. This technique can be used to trap the exceptions whenever the application system uses a database management system. Okay, fine. Then the second point I told you, right, we will discuss with an example, then it will be easy for you to understand, or else it will become too much of theory. The third point was advantage of CIS is that it doesn't require modifications to the application system and yet provides an online auditing capability. Even this point also can be understood well once you have seen the example. Now, see, just I'm explaining the diagram so that you can be able to follow easily. There is a client where the data will be entered by the client and the data will be processed in the application software. Finally, it will get posted in the DBMS. It is similar to the integrated test facility diagram, right? Where there will be a production data processed in the application. Finally, it gets posted to the database. Okay, this is the standard flow. I can say this flow doesn't require any further explanation, because this is how in general the transaction happens. At a client machines, they punch in the data will get processed in the application server, and finally it get posted to the database server. Okay, now what is this CIS does? There will be a simulator. Okay, so whenever a transaction was entered by the user in his client machine, it get processed in the application software, because application software has all the business logic. Neither the client nor the database has the business logic, only the application software has the business logic. So when they enter the transaction, the business logic is existing in the application software. Using that logic, the transaction get processed. Finally it get posted in the database. Okay, so to give a more meaningful way, let's say the same example, if somebody entered a supplier invoice Okay, all the validations, whether the supplier is active or not, whether the supplier that invoice date is in open period or not, all those validation happens in the application server, and finally the entry get posted. Let's say debit expense to credit supplier liability account. So this entry get posted in the database. This is how the transaction happens. Now, what is the additional thing, the step in this CIS tool? There will be a simulator which resides outside of the application system, unlike the scarf or a snapshot or ITF, where these tools are put it in the client application system, which we felt is risky in one way or the other. But in the CIS case, this is not in the application software, right? See there, so application software is here, the simulator is residing separately. Okay, so this is one of the major difference in CIS versus other previously discussed techniques. What it does, so this transaction is getting posted right in general case, but going forward what happens, this database got a request for a particular transaction to get posted, it sends the same information to the simulator. Hey, I need to accept on a particular transaction. Before I accept the transaction, can you please check once? So what this simulator does, so it takes this transaction, whatever the logic followed by the application software, the same logic it also follows and tries to calculate the output. Okay, so on the same invoice transaction, it applies that validation logic and all the checks whatever the application software does, and create a output. So it also created this is what I captured here, the CIS results. Okay, so even here also you got expense debit to liability account, then application software already has the result whatever we discussed right here. The same result will be in the application software. That result will be compared with the CIS result. If both are tallied, well and good. If there is any variance or exception, that will be logged into the log file. Okay, it is almost look like your ITF, but the major difference versus ITF and the CIS, in ITF you need to create the test data. Okay, but here we are not creating any test data. What we are doing, on the same production data, you are recalculating it one more time, nothing more than that. And also in ITF, the software is installed in the application system, means you have creating some dummy master files also, whereas in CIS you need not create any new data for your testing. All you are doing was using the existing data and you are processing it one more time. So as per your process, you will be getting one result. This is what I'm talking about, the CIS result, and at the same time application will also have one result. So these two results will be compared. If there is any difference, that will be logged to the exception file or the exception log file. So this is what the CIS means. Now let's go back to the remaining definition. Then let's see if you still have any doubts. So this is the section now. CIS is executed in the following way. DBMS reads an application system transactions and it passed to the CIS, right? So before the transaction get posted in the DBMS, it sends the instruction to the CIS. Hey, I got a transaction. Can you please have a look at it once? Then what CIS does? It checks whether it has to determine, like whether it has to examine the transaction further or not. Why this check has to be done? If not, what every transaction that is getting hit to the DBMS, if it has to be validated by CIS, then that won't make sense, right? Think about the volume of transactions on a daily basis it happens, and that too. Let's say if I am checking for one particular supplier, then if I am going to check on the same supplier one more transaction, what is the additional assurance I get? Okay, or you simply understand, if I am testing one category of transaction, testing again and again on the same category of transactions will not give any additional result. So that is the reason it has to check whether it has to examine the transaction further or not. Once it checks and decides, now yes, I want to investigate further, it will go on to the third point. What it does, it replicates or simulates the application system processing. Whatever the application system does on the same transaction, it replicates the same processing on this transaction. Every update to the database that arises from processing the selected transaction will be checked by CIS to determine whether any discrepancies exist. Okay, so it will check the CIS result versus application system results if there are any descriptions that were logged to exception log file. So this is what we discussed even in the flow chart. Okay, I hope you understood now what is CIS. Again, the one of the last point I'm reiterating once again, advantage of CIS is that it doesn't require any modifications to the application system, because you're not at all installing the CIS on the application system. You are keeping outside of it, and also you are not creating any dummy data in the application system. All you are doing was reprocessing the same transaction one more time. Okay, this is about continuous and intermittent solution, CIS. Now, the last tool we are going to discuss is about audit hooks. This way, it's one of the simplest tool I can say. See, audit hook, similar to the diagram, how a fish will be caught with these hooks when you are doing that fishing part. Similarly, what auditors does, using this software, they create some red flags. Okay, okay, whenever any transaction meets or satisfies these conditions, automatically the transaction will be picked and put it in a separate log file. So auditors reviews, not in a separate file. Whenever this transaction happens, the software gives a notification to the supplier. Okay, in all the previous cases, what happens, all the observations done by the tools are recorded in a separate files. Again, auditor has to manually come and review, right? But in this audit hook software, the software sends a notification to the auditor, hey, there is some fraudulent or some suspicious transaction happened based on the criteria you have given, so please have a look at it. Once the auditor get a notification on his terminal, he will go and quickly check the transaction. Like, it's a good tool in one way, because the alert happens at a very same time when the transaction happens. Unlike in all other cases, those observations or deviations are recorded in a separate file. Again, auditor has to come and review. Okay, so this is what an audit hook. Let's have a quick look at the definition. It's easy to understand. So these are the audit routines that flag suspicious transactions. Okay, so the system flags, means the software flags suspicious transaction. But again, how system knows whether this transaction is a suspicious or not? Auditor has to give the criteria. Example, let's say uh, I have one supplier. Basically, in many ERPs, you have this functionality. I categorize that supplier as one-time supplier, means I'm not going to deal with the supplier again and again. So I categorized this supplier as a one-time supplier. But I created an audit hook which says that, hey, find any transaction with the suppliers who are one-time suppliers, but there are more invoices with the suppliers. Okay, if you are doing more invoices with the supplier, why you need to categorize that supplier as a one-time supplier? Okay, so in this way, I configured this criteria in the audit hook software. Whenever more than one transaction happens to a supplier which is already designated as a one time, this audit hook gives a notification to the auditor, so that auditor will have a look at the transaction and see whether this is genuine or not. Again, when audit hooks are employed, they can be informed of questionable transactions as soon as they occur. This is the major advantage of audit hook. Okay, and this approach of real-time notification, it displays on a message on the auditor's terminal. So they will have a separate terminal or a screen where they can see these notifications and act accordingly. So this is about audit hooks. Okay, I hope you understood all the five tools. One is the snapshot and ITF, scarf, CIS, and audit hooks. Okay, if you have any doubts, please post in the comment section. I'll be happy to help you with the explanation. Thank you for watching the session. If you like these videos, please subscribe to my channel. Thank you so much. Have a nice day ahead.